In this video, I will be guiding you through Chapter 5.2, Cash Flow Forecasting and Working Capital. These are the syllabus statements. So, what is the importance of cash and cash flow forecasting? Well, first of all, what is cash? Cash is the most liquid of assets, meaning it is immediately available for spending. This is similar to having cash in your wallet. You can spend it whenever you please. Cash is also important to help support a loan for a business. So the bank will need to assess whether the business has sufficient cash to repay its debts. Furthermore, they also know how much cash is available for the business. So if they don't, they can arrange a source of finance if required. Also, it is to identify potential cash problems so they can cut back on spending. And lastly, is to see if the business is holding too much cash, because holding too much cash means that they are not spending cash in other areas of the business which could be more profitable. So, what is a cash flow forecast? It is the inflows and outflows of the cash of a business. So some examples of inflows include sales of goods in cash, debtor payments in cash. So this is the people that owe you money, borrowing money, such as a bank loan, sales of assets, which get you cash, and also the sale of shares, which are also settled in cash. Now, the outflows of a cash flow forecast is purchasing raw materials, such as cost of goods sold, paying wages, usually in cash, very rarely in shares, purchasing fixed assets, such as machines, repaying back loans, like a bank loan, and paying suppliers. Okay, so I just wanted to emphasize that cash is really not profit, right? Because profit is not immediately available for spending, but cash is. So what that means is that, let's say, for instance, the fish in this example is the business, and the water represents the cash. And the big reserve bucket here on the right represents the profits of the business. So what happens when the water in the fish tank depletes? That means that the fish dies. So very similar to when a business runs out of cash, which is no water, the business goes bankrupt, the fish dies. No matter how much profit is available to the business at a later date, this does not matter because the fish requires water immediately, like the business needs cash immediately, and without water, the fish dies. Without cash, the business goes insolvent. Okay, so moving on to cash flow forecasting. So what is it? It is a projection of anticipated monthly cash flows to estimate the future cash requirements of a business. So essentially, it's a financial budget for cash, and it measures the expected monthly in and outflows of a business, and usually it's over a period of 1 year. When the inflows are greater than the outflows, that's a surplus, and when the outflows are greater than the inflows, this is a deficit. So this is my example of a cash flow forecast. First of all, we have our cash inflows at the top, and my total cash inflows will be $10,500. Our cash outflows are $5,500 because I need to pay for my equipment, materials, loan repayments, rent, electricity, and insurance, etc., etc. Now the net cash flow would be $5,000, which is $10,500 minus $5,500, which gives me $5,000 net cash flow. My closing balance will be $5,000. Now the opening balance for my next month will be my closing balance of the previous month. So in this case, $5,000. I have zero total cash inflows for this month, but my total cash outflows will be $10,000. So my cash flow for that month is minus $10,000. Now, because I have an opening balance at $5,000 here, what I need to do is calculate my closing balance for February, which is $5,000 minus $10,000, which is minus $5,000. And remember, My closing balance for February means my opening balance for March is the same, which is minus $5,000. This month I did a little better. My inflows were $10,000, but my outflows again were $12,500, which gives me a net cash flow of minus $2,500. And now I need to add them together, which is minus $5,000 plus minus $2,500 will get me a total of minus $7,500. Not doing terribly great this month. So the opening balance for the next month is minus $7,500. But my total cash inflows for this month will be $25,000, and my total cash outflows is $13,000, which gives me a net cash flow of $11,700. Now, minus $7,500 plus $11,700 will give me a closing balance of $4,200, which is positive. My next month, because my closing balance of April is my opening balance of May, gives me $4,200. And for that month, my total cash inflows are $25,000. And my total cash outflows are $12,500. So $25,000 minus $12,500 will give me a net cash flow of $12,500. And my closing balance will be $16,700, which is $4,200 plus $12,500. And again, my opening balance for June is $16,700 because it is the same as my closing balance for May. Total cash inflows for June will be $18,000. And my total cash outflows will be $12,500. Netting me a net cash flow of $5,500. And this gives me a closing balance of $22,200, which is $16,700 plus $5,500. Okay, so moving on to methods to overcome short-term cash flow problems. So what a business can do is to go cash only, right? So customers can only pay in cash. No credit, no buy now, pay later. Just sometimes businesses even give a 10% discount for going cash only. This is to incentivize, again, for cash sales, which will improve their cash position. Another method is that they can take out an overdraft. This is a short-term injection of cash. However, they need to pay a very high interest rate, and this could account for their cash outflow. Another method is to increase their bank loan. This is a short-term injection of cash, but then again, they have to pay interest on this loan. Another method is to delay supplier payments. This will reduce the short-term cash outflows for 30, 60 to 90 days. However, some suppliers might just refuse this. Another example is to ask your debtors or the people that owe you money to pay back more quickly. So this means that your cash inflows will increase more in the short term, but the problem is that the customers might just go somewhere else, and this will reduce demand for your products, and less revenue and less profit will be received. So moving on to the concept of working capital. So the importance of working capital. This is the capital a business has readily available to fund its day-to-day running costs. So this is really the lifeblood of the business, having a positive working capital. This is essentially to keep the lights on, and the calculation or the formula is current assets minus current liabilities. Now, just to remind you what current assets and current liabilities are. A current asset, some examples include cash, inventory, trade receivables, and shares/securities. So these are the assets that you can convert into cash relatively quickly. Current liabilities are essentially short-term debt. Some examples include short-term debt, like overdrafts, interest payable, which is usually paid every month, unpaid bills and utilities, which you need to pay for these every month, and also trade payables. So what does a positive working capital actually mean? It means that you have more cash and assets that can be converted into cash relatively quickly are higher than your short-term debts. But on the inverse, if you have negative working capital, this means that you have less cash and things that can be converted into cash relatively quickly, and this is lower than your short-term debts. And this will give you negative working capital, which is very bad for any business. So moving on to the solved examination questions. Please be reminded that I have an examination technique playlist in the description below. Outline 2 reasons why managing cash flow might be important for the TDG. Reason 1, able to pay their bicycle suppliers on time and to repay short-term debts of the retailer. Next, explain 2 ways TDG could overcome its short-term cash flow problem in September. Way 1, insist on cash-only sales. This means that they can receive cash sooner for their retailer. Way 2, to request debtors to pay quickly, as cash will be received earlier to pay their 3 employees. Explain 2 ways SMR could improve its cash flow problems. Way 1, to increase their bank loan. This will give them a better working capital for their food business. Way 2, to delay payments to creditors. This means that they will hold on to their cash reserves for longer. This will enable them to pay their 3 part-time employees on time. Do you think that making profit is more important for a business than managing its cash flow? Yes, as profit is the reward for risk-taking, as the CEOs have taken the financial risk to start their business and to become successful. No, cash flow is more important, as it's to fund the day-to-day operations, such as paying employees, suppliers, creditors, and paying rent. Profit is not the most important, because a business can continue to operate without making any profit. Therefore, cash flow is the most important, as insufficient cash will result in an insolvent business. I hope that helped. Hope you have a good day. Bye-bye.